Hey everyone, welcome back to the show. My name is Mike. This is my whiteboard, and today we're going to be talking about why we rarely roll defined risk. So if you're brand new to this show, this is a concept show where we take those concepts, we break them down, and we construct them visually for you. So today we're really going to be talking about why it's hard to roll defined risk trades and what the consequences are of doing so, and why we normally just let them expire or close the trade prior to expiration. So we're going to walk through some undefined risk trades. We're going to show you the counterpart defined risk trades and what we would have to do to roll them for a credit. So I speak of rolling for a credit, and that's one of our goals when we're looking to roll a trade in general. So on the next slide here, we're going to break down our top goals for rolling a trade in general. So when we're rolling, we have a few goals. So the number one goal is to keep the dream alive. And what I mean by that, and what you might hear, is that we're keeping the dream alive, we're rolling for duration, we're having the same assumption, and basically we're letting ourselves have more time to be correct on the trade. So keeping the dream alive is really just referring to extending duration and allowing ourselves to hopefully be right in the long run. Secondly, what we're going to be doing is going to be rolling for a credit or for zero. So if we're rolling for zero debit, zero credit, nothing at all, basically what we're doing is we're not hindering our max profit, we're not hindering our max loss, we're just rolling into duration without collecting anything or paying anything to do so. So if we can roll for a credit or for zero, we'll definitely go ahead and do that. And lastly, the number one goal I would say is to reduce cost basis further. So whenever we roll a position, in the back of our minds, we're going to be rolling for a credit, hopefully, so that we can reduce our cost basis further, since we never really know what's going to happen in the markets. But if we position ourselves to have a lower and lower cost basis, that's going to give us a higher and higher probability of being successful in the long run. So let's go to the next slide here, and we'll talk about how we roll undefined risk trades, which is going to show you how quick and easy it will be when you're looking at undefined risk trades. So on the top here, you can see that we've got a trade. So let's say we're selling a put at the 100 strike. We've got our stock price at 110 there, and we've got the perfect 45-day till expiration time frame. So let's say I collected a $1 credit for that. So I'm 10 points away. I've got a great high probability trade, and I collected a $1 credit, which would mean my max profit on this trade is $1 or $100. And my strike is all the way down to 100. So the stock price can move anywhere near 100, even down to 99, and I'll still break even on the trade. So I like this trade. I've got myself a high probability trade here. But let's say it goes against me. So over the next 40 days, you can see over the left here, we've got 5 days till expiration left. So the stock price is all the way down to 95. Since I sold the put at 100, in order to close that position or roll the position, what I would have to do is close out my current position. So I'd be looking at the 100 strike and roll out or open a new position in a further expiration on the same strike. So given the fact that the stock price is at 90 and my strike price is at 100, I know that my option is going to be trading for at least $5 or $500. And you might be thinking to yourself, how can I calculate this? Well, it all boils down to intrinsic value. So if you missed my previous whiteboard on intrinsic value, I strongly suggest you check it out. Just go to the top, click on Find Shows, scroll down to Mike and his whiteboard, and you'll see it there. But when we're talking about intrinsic value, we're talking about the real value of the position. So when I'm selling a put, I'm essentially selling the right to someone else to sell their shares to me. In other words, I'm gaining the right to potentially purchase these shares at the 100 strike. So if the stock price is at 95 and I'm really getting the opportunity to get long these shares at 100, I know that there's going to be 5 points of intrinsic value in there. However, since there's still 5 days till expiration, I know there's also going to be time and volatility value, which is going to be that extrinsic value we always refer to. So you can see here that if I wanted to close this trade and open a new one, I would be closing this trade for somewhere around 503, maybe 505, 510. The real key is to understand that it's going to be trading for at least $5 here. So we know that rolling a trade is just closing our current position and opening a new one. So if I do just that with undefined risk, I would simply be closing my current expiration, rolling out to the next expiration. So I'm really just closing my 100 strike, going out to the next expiration and selling that same exact strike put, so the 100, but in the next expiration cycle. So in doing so, let's say I can get a $5.75 credit for opening this new option with 50 days to go. So what I've really done here is close my current position. I did in fact lock in that loss temporarily, but I opened a new position and that's worth $5.75. So if I take the difference here, 503 debit, which is what I'm paying back, that's what I'm closing my position for, and I'm opening my new position for $5.75 credit, the net roll here is going to be a 72-cent credit. So all I'm really doing is just taking the closing position cost, adding in my current opening position, my new position credit, and it gives me the difference of 72 cents. So now the important thing to realize is that, number one, I've collected more credit, which is going to reduce my cost basis further. So wherever my break-even point was originally, so if I look back here, I sold this put for $1, and it's at the 100 strike, so my break-even would be at 99. But now, since I sold this additional net credit of 72 cents, my break-even would be 72 cents lower. So that's what we can do here with rolling an undefined risk position. And what's cool about this is that we don't acquire any more risk because really our option is on the 100 strike still. We're just adding more time. We're collecting the extrinsic value in this 50 days till expiration option. And basically, the only difference is the intrinsic value. So, of course, I'm closing this for more than 5 points, but I know that if I sell the same strike, it's going to be worth at least 5 points and more because of the fact that we're looking at 50 days till expiration as opposed to 5. So looking at this in totality, you can clearly see that it's really clean and simple when we're looking at rolling undefined risk trades. I collect more credit, I reduce my cost basis further, and I don't acquire any more risk when it comes to specifically selling this same short put. So originally I had one short put. I still have one short put. I did lock in that loss temporarily, but if the stock price comes back up above 100, I would have wiped out that entire loss and realized the profit of my original credit here of $100 in addition to this net credit here of $72. So my total new profit would be $172 if I were to let that option expire if the stock price came back up above 100. So we've got all these things going for us with undefined risk trades. And that's why you'll always normally see us rolling undefined risk trades if we have the same assumption. So let's take a look at the next slide and we'll break this down. Same exact example, but we're going to look at what a defined risk trade would look like. So we've got the same exact criteria. We've got 45 days. We're looking to close that position at 5 days and roll it out to the 50 days till expiration time frame. So now instead of collecting a $1 credit, I'm only collecting a 66-cent credit. And the reason for that is because instead of just selling this naked 100 put, I'm also buying a 98 put in the back further out of the money area. So what I'm doing is selling this option for $1, but at the same time, I'm also buying this option for a value that's going to give me that net credit of 66 cents. So really what this does here is, number one, it defines my risk to the downside. So the most I can lose on this trade is no longer the full value of 100 because even if the stock price goes to 0, since I would be long shares at 100, I would also be short shares at 98. So that's going to offset the loss if the stock price drops anywhere below 98. It does not matter where it is. It's going to offset the loss and define my risk. So that's one reason why I might look to put on this trade in the first place. But now let's take a look what happens when I close the trade. So we can see that this trade is 2 points wide, and I know that because I sold the put at 100 and I bought the put at 98 there. So if I'm going to close the trade and the stock price is at 95, these two options are now completely in the money. Up here we were looking at selling the options and the spread when they were out of the money, but now since the stock price is below my options, these puts have intrinsic value, and I've got the debit here of 201, because normally when we're closing trades that are not right at expiration, there's still going to be some extrinsic value there. So although the spread is 2 points wide, I might have to pay 201 or 202 to close out of this spread. So we're giving ourselves the benefit of the doubt here and looking at closing the spread for 201. Now here's where the tricky part comes in. You might think that, well, I closed this spread for 201, I should at least be getting more than $2 for opening a new spread that's in the money with 50 days to go. But that's not the case. So in a lot of instances, when we're looking at rolling defined risk spreads, when they're completely in the money, we're actually going to have a net debit trade. And the reasoning for this is that we're not just selling this option. We have to remember that we're buying this 98 option as well. And as we know, the more extrinsic value is going to be in those at-the-money options. So even though this put will have more total value, there's going to be more extrinsic value in this long put that we're buying, which is going to offset the total credit that we're receiving in that new trade. So if I'm closing my trade for a 201 debit and opening my new trade with 50 days to go for a $1.40 credit, I'm going to see a 61-cent debit on this trade. So what does this mean? Basically, what I would be doing here is keeping the dream alive, of course. I've got my spread still open. I've got the same assumption. However, I'm hurting my profit potential. So if I originally collected 66 cents and now I'm rolling for a debit of 61 cents, best case scenario is that the stock price goes all the way up back above 100 and this spread expires worthless. However, since I closed for a debit of 201, opened my new trade for $1.40, which resulted in that 61-cent debit, if I take a look at my credit of 66 cents and look at the debit here, my net total, if the stock price ends up coming back up, is only 5 cents. You total in all the commissions with that, and we've got ourselves a losing trade. So this is why you don't see us rolling the same strikes just out in duration as you might see with undefined risk. But if we go to the next slide, we can quickly show you how we might do this to adjust our risk. So instead of choosing the same strikes, when we go down here to the 50 days till expiration, maybe we would look at adjusting the long strike. So if I move the long strike even further down, I could get a larger credit than the debit I paid, which would give me that credit at the end. So I would see a net credit on this position. But what's really important about this is that, yes, I'm paying less for the 94 put that I'm buying, but I'm tripling my risk here, because now I've got a 6-point wide spread from 100 to 94 as opposed to 100 to 98. So this is one thing we could do, but we're adjusting our risk, and maybe that's not what we're comfortable with, which is why we might have been in defined risk in the first place. So let's wrap this all together with some takeaways here. Rolling undefined risk covers all of our goals. As you saw in the first example, rolling undefined risk allows us to reduce our cost basis, keep the dream alive, and increase our profit potential and move our break even further down, which is what we're looking for. Rolling defined risk covers some of the goals. Yes, we can keep our dream alive, but we're not going to be able to normally do it for a debit, which is going to hurt our original profit potential. Lastly, we must adjust the defined risk strikes if we want to roll for a credit when we're looking at a credit spread that's totally in the money, and maybe we're not comfortable with that. So we like to do it here to just let those spreads expire, or just let them ride out and accept that max loss because we knew what that was going in. So thanks for tuning in. This has been Rolling Defined Risk and why it's so difficult. If you've got any questions or feedback, shoot it over to support@dough.com, or you can shoot me a tweet at DoughTraderMike. Shadow traders are coming up next, so stay tuned. Hey everyone, thanks for watching our video.
If you liked this video, give it a thumbs up or share it with a friend.
Click below to watch more videos, subscribe to our channel, or go to our website.